Should I focus on growth stocks or dividend stocks? Another investing topic that's so polarizing. There are diehard fans of both strategies. So in this video, I'll show you what the data says, how growth and dividend strategies behave in different markets, and most importantly, which approach suits where you are on your investing journey. Back in the day, dividends were why investors bought businesses. You didn't need to wait to sell an investment. You got income from it straight away. But take a look around today, and it feels like dividends have hit a dead end. When a company makes a profit, it has a choice of what to do with it. It can either reinvest those profits back into the business to further its growth, or it can pay out a dividend to its shareholders. That could be to reward existing shareholders, or it could be to incentivize new investors. For companies like Nvidia, they prefer to reinvest their profits back into the business, whereas companies like McDonald's or Coca-Cola, they prefer to pay out their profits to shareholders. And historically, strong dividend-paying companies have tended to be more mature businesses that are likely to be more stable, but they won't get this same explosive growth that big tech stocks do. Today's landscape is dominated by the big tech companies that have to pour billions into research and development to keep growing and to stay competitive. These businesses, of course, will likely evolve as time goes on, and it could be that today's tech companies could be the mature dividend-paying businesses of tomorrow. But the key is what makes most sense for where you are on your investing journey. And we can split this into two main phases, an accumulation phase and a decumulation phase. During our working life, when we're looking to grow our wealth, paying into a pension, invest and save. And then when we come to retire, when we want to draw from those investments to create the income that we're likely to give up from when we retire. The obvious solution could be to say that dividends are more popular in retirement because of the income potential. But because dividends can be reinvested, they can become a growth strategy. You'll hear people talk about a dividend snowball, and this is whereby that you get paid out a dividend, you reinvest it to buy more shares, and because a company pays a dividend per share, the more shares that you can accumulate every time you get paid that dividend, if the dividend rate stays the same or increases, every dividend that you get paid will get more and more, and you buy more shares, and that snowball gets bigger and bigger as time goes on. To show how powerful this compounding effect can be, this is looking at the S&P 500 from 1930. Starting from a unit of 1, the capital would have grown to 278. So any dividends that were paid, you would have used that as income. However, if you had reinvested those dividends, starting from the same place, your investment would have grown to 9,584. But in the accumulation phase, the most important aspect is total return. It's very easy to think, I'll likely want some income in retirement in the form of dividends rather than selling down shares. So I may as well just start with that approach now. Let's put some numbers to this so we can see what that looks like. We're going to look at the S&P 500 Dividend Aristocrats Index, a very prestigious index that only allows companies that have followed a policy of increasing dividends for at least 25 consecutive years. You will get companies that will increase their dividends by the smallest amount just so they can stay within this index, but it still follows the traits that these are likely to be more mature, stable businesses. In the UK and Europe, there isn't actually an ETF that directly tracks this index, but there is this ETF which is very similar from State Street. It uses a slightly broader index in the S&P Composite 1500, but it follows the same traits. I'm going to compare this ETF to a typical S&P 500 ETF over different time frames. The blue line is the typical S&P 500 ETF, with the orange being the Dividend Aristocrats ETF. And these performance figures have already taken into account dividends being reinvested. And the first thing you'll notice when we compare the performance is just how closely they tracked each other. From when they were incepted about 2011 up until about 2018, when the lines start to move away from each other. And this coincides with when the big tech companies like Nvidia really started to rally. And you can see the blue line start to move away. This dip here was the COVID crash, and the recovery from that was just insane for big tech stocks. And that's why you can see the blue line moving away so steeply. They then started to come together again in about 2022, and we can zoom into that a little bit further. It was during this time that inflation had run out of control due to the stimulus and the money printing during the pandemic. And now interest rates were starting to be increased dramatically to try and curb that inflation. And this caused quite a big sell-off in the stock market, with the S&P 500 of 2022 finishing 8.47% down. If we compare that to the Dividend Aristocrats ETF, it actually performed up 11%. And this is one of the biggest examples of the traits of each of these two ETFs. That during market downturns, the Dividend Aristocrats fund tends to be more stable and actually performs quite well, even though the S&P 500 has outperformed over this time period. It's been a lot more volatile. Another example was March this year, when Trump announced tariffs on the rest of the world, and we saw a massive sell-off in the stock market. There was a little sell-off in this dividends fund, but it was very shallow compared to the S&P 500. But again, similar to what happened in March 2020, the recovery from this dip has just been insane for those big stocks in the S&P 500. And it started to move away again from a typical dividend ETF. And that means when we look at a 5-year period, the S&P 500 fund has performed more than double that of the dividend fund. But that doesn't tell the whole story, because this data only goes back to 2011, which is when these two ETFs were incepted. And that coincides with the rise of these big tech stocks that prefer to reinvest their profits. And if they do have any excess profits, they might prefer to do share buybacks rather than pay out dividends. If we look over a 20-year period, we can actually see the annual performance is almost identical. And if we compare from when the Dividend Aristocrats Index was incepted in 1989, it's actually outperformed the S&P 500. Average annual returns of 11.6% versus 10.6%. What's also interesting to compare are the risk-adjusted returns. And this is a level of return that you get for a unit of risk that you take. And since 1989, the Dividend Aristocrats Index has a risk-adjusted return of 0.8 versus 0.7 for the S&P 500. And what that highlights is that the S&P 500 is more volatile. It will have more explosive periods, but it will also have more dramatic falls. Whereas the Dividend Aristocrats Index is slightly more stable. And these two indexes performing roughly the same over a long period is also highlighted when we look at the average outperformance over the S&P 500 of the Dividend Aristocrats Index. Over all months for this data, as you would expect, it's just over half at 51.66%. But what's interesting is in up months, it actually underperforms the S&P 500, sitting at 43.88%. And that shows that when the market is rallying and in bull markets, it's better to be in those growth stocks that are likely to outperform. Whereas in down months, the Dividend Aristocrats Index outperforms 66% of the time. If we look at the three most recent stock market crashes, the dot-com bubble in the early 2000s, the global financial crisis in 2008, and the pandemic fallout in 2022. And every time the stock market has crashed, the S&P 500 has underperformed the aristocrats. In the dot-com crash, it didn't even go negative until the third year. But what we can then see more recently is every time there's an up year, the S&P 500 has essentially either matched or outperformed the aristocrats index. So the tricky thing for investors deciding between these two strategies is determining whether this is the new normal, whether going forward companies will prefer to reinvest their profits or to do share buybacks rather than pay out dividends. From 1926 until this year, dividend income made up about 31% of the monthly total return for the S&P 500. But just look what it was in the 1990s and the 2010s, 14 and 15%, less than half that of the long-term average. So you could summarize that as you'll get a smoother ride with a dividend strategy, but you could be giving up potential returns. So you could say the decumulation phase is where a dividend strategy really appeals, and that's largely down to sequencing risk. This is the risk of a market crash just after you start taking income from a retirement pot. The blue line is what would never happen in reality, but it acts as a baseline. If you take out 20,000 but the market goes up 20,000, you still got the same amount. The green line is what would happen if a market crash occurs just after you taking income from your pot. Even though the market might recover, because that pot has been reduced by you taking income, it never recovers. The orange line is what happens when a market crash occurs quite long after you start taking income. Because the fund has had time to grow, even when the market does crash, it's still painful, but you've still ended up with roughly the same as what you started with. And therefore, because dividend strategies like the aristocrats historically have fallen less in bad markets, that can make them more attractive in later life, where protecting the downside matters more than squeezing out every last bit of upside, plus the potential for income. On the income, you will have a decision between quality and yield. That aristocrats ETF that we looked at only has a dividend yield of around 2%. That's because they're very high quality companies. They're more likely to be stable in the long run. You will get companies that pay much higher yields, but they might not be as consistent, and they'll likely come with a little bit more volatility. So really it comes down to your age and what type of investor you are. Young investors in the accumulation phase will be happy with volatility. They don't need the income in the near term. They can ride out any volatility. Markets tend to go up more than they go down. Broad, low-cost growth ETFs have performed very well historically, and any dividends that the companies do pay, you can invest into an accumulation fund, which reinvests those dividends automatically for you. However, for pre-retirees, they prefer stability and cash flow. A quality dividend-tilted portfolio has had shallower drawdowns and better risk-adjusted returns. You still get equity exposure, the ride just tends to be a bit smoother. And you don't need to pick a side. You can have a blended approach. You just need the right mix for your stage of life. If you want to explore this or any other concept further, I've just set up a Discord investing community, a place to chat all things UK-focused investing. I'll be in there every day answering questions, and it will remain free for early members. Let me know your thoughts down below in the comments. If you're worried about the next stock market crash, then watch this video next to learn how to prepare for it. Thanks for watching. I'll catch you in the next one.